U.S. Treasury securities, bills, notes, and bonds are considered some of the safest investments in the world, backed by the full faith and credit of the U.S. government. While all three serve as debt instruments that raise money for federal operations, they differ in key ways such as maturity lengths, interest payments, risk exposure, and investment appeal. Understanding these differences is crucial for investors aiming to diversify their portfolios, manage risk, or secure predictable income. This video outlines the top 10 differences between Treasury bills, notes, and bonds to help you make informed investment decisions. 1. Maturity periods. The primary difference lies in how long each security takes to mature. Treasury bills, T-bills, are short-term investments with maturities of 1 year or less, typically offered in 4, 8, 13, 26, or 52-week terms. Treasury notes, T-notes, have medium-term maturities of 2, 3, 5, 7, or 10 years, while Treasury bonds, T-bonds, are long-term investments with maturities of 20 or 30 years. 2. Interest payments. T-bills do not offer periodic interest payments. Instead, they are sold at a discount and mature at face value, with the difference representing the investor's return. T-notes and T-bonds, on the other hand, pay semi-annual interest, coupon payments, to investors and return the face value upon maturity, providing regular income over time. 3. Investment goals. T-bills are preferred for short-term liquidity needs and low-risk savings strategies. T-notes are ideal for moderate-term financial planning or income needs, such as funding a child's education in a few years. T-bonds are chosen by those with long-term financial goals, like retirement planning or locking in fixed income for decades. 4. Price volatility. Due to their short maturity, T-bills have the least price volatility, making them relatively insensitive to interest rate changes. T-notes show moderate price fluctuation, while T-bonds experience higher volatility, especially when interest rates change significantly, as their longer duration amplifies sensitivity. 5. Risk exposure. All three are considered virtually risk-free in terms of credit risk, but they differ in interest rate risk. T-bills have minimal interest rate risk because of their short duration. T-notes and especially T-bonds are more exposed, meaning their prices can fall significantly if interest rates rise after purchase. 6. Purchase method and denomination. All three can be purchased through treasurydirect.gov, banks, or brokers. The minimum purchase is typically $100 for each. While the process of purchasing is similar, the frequency of auctions varies. T-bills are auctioned weekly, T-notes are sold monthly or quarterly, and T-bonds are usually issued less frequently. 7. Tax treatment. All three types of securities are exempt from state and local income taxes on interest income but are subject to federal income tax. This makes them particularly attractive for investors in high-tax states. However, since T-bills are sold at a discount, the interest is technically the difference between purchase and maturity value, which is fully taxable. 8. Secondary market liquidity. T-bills are highly liquid and widely traded on the secondary market due to their short durations and broad appeal. T-notes also enjoy high liquidity. T-bonds are tradable as well, but their longer terms can make them less desirable to certain investors, affecting how quickly they can be sold at favorable prices. 9. Yield differences. T-bills typically offer lower yields than T-notes and T-bonds, reflecting their shorter durations and reduced risk exposure. T-notes yield more than T-bills, and T-bonds offer the highest yields among the three, compensating for the increased risk of locking up money for decades. 10. Use in portfolio strategy. Investors often use T-bills for emergency funds, cash reserves, or short-term parking of capital. T-notes are common in balanced portfolios that require steady income and moderate risk. T-bonds are favored by long-term investors and institutions seeking predictable income over many years or using them as a hedge against stock market volatility. Treasury bills, notes, and bonds each serve distinct purposes in an investor's toolkit. While they share the backing of the U.S. government, their differences in maturity, interest structure, yield, and market behavior make them suitable for varying financial goals and risk appetites. Whether you're looking for short-term safety, mid-term income, or long-term fixed returns. Understanding these differences is key to building a sound investment strategy. Always consider your time horizon, cash flow needs, and risk tolerance when selecting the right Treasury security for your portfolio.